Let's look at now at real estate as an asset class. So what I'm sharing with you right now is basically a long-term view of real estate. And what we see here is what this is the Case-Shiller S&P 500. The Case-Shiller chart, basically, which tries to communicate what are the factors that are impacting the real estate index, okay? And what we see, this index start being tracked since the late 1980s. And what we see that over time it fluctuates. The important period that we're going to be looking at is post Second World War. And what we see that it fluctuates over time, we see some bumps, okay, which we're going to be talking about it in a second. So what are actually the factors that are impacting the real estate index, okay? And what we see here is obviously the first one is the cost, the interest rate, which is basically the cost of capital. And as we see that over a very, very long period of time, it's relatively flat. And with the exception here, we see here at 21.5, which was in the Reagan-Carter years, where the inflation was very high. And today's rates are roughly about 3.5 is on the high end. Today you can find a 30-year fix for around 3%. Obviously it depends on your FICO score, the to income, and many other factors. But in general, it's around 3.5%. During this year, we had a huge inflation, and anyone can imagine and look at their interest rate on the mortgage rate. If they would have to pay 21.5%, it's basically most of people would not be able to make those kind of payments. Obviously, the prices of home during that time is by far not what it is today. The second factor that is impacting, obviously, the real estate index is the population. And as you can see, that the US population from the late 1880s is growing steadily. And that is a very, very important factor. And if we look at currently what's the population in the United States as of basically January of this year, we see we are about 330 million people. We have one birth every 8 seconds, deaths every 11 seconds. I'm sure these numbers are a little bit different today with the coronavirus. One international migrant every day, 34 seconds, and a net gain in one person every 19 seconds. So that is a very important fact that basically fuels the US economy, unlike many other Western countries, Europe, Russia, and Japan and others, which they have actually a negative population growth, which is very critical, has a very severe long-term implication about the economy, people retiring and so on. But nevertheless, though, this is a very important factor that impacts the continued growth of the US economy. The other factors which is impacting the real estate housing index is the building cost. And when we talk about building costs, we obviously have from land, materials such as lumber, copper, steel, and so on and so forth, labor and so on. So those components also fluctuate with inflation, and they fluctuate based on the geography. We know that Silicon Valley is very expensive compared to maybe areas like Atlanta, Arizona, Tennessee, and so on. And that's the factors. And if we look at the end of last year, we see that the US median price was roughly about $270,000, and its appreciation from the previous year was about almost 3.7%. But the interesting thing here is that you see if we divide it to two main components, one which is land, and the other one is the construction. As we said, the construction is labor, materials, utilities, and so on and so forth. In the United States, on average, the land cost is about 1/3, and the construction cost is 2/3. If we look at Silicon Valley and we look at Palo Alto particularly, we see the reverse, that the cost of construction is about 30% and the cost of land is about 70%. And that's a very interesting distinction because the land component basically tells everyone that this depends on the local economy, the local industry, and the local demographics. While the cost of construction, even in Silicon Valley, if you compare the Silicon Valley cost of construction to other places' cost of construction, it's probably about almost 50% more expensive. For instance, some of the investment properties that we buy in areas like Tennessee and Arizona and Atlanta, the cost of construction per square foot of, let's say, let's call it average Home Depot quality is about $100 to $150 per square foot. In Silicon Valley, the cost of construction on similar quality home is $250 to $350. So we see the cost of construction locally. It depends also obviously on the cost of rent, the cost of employment, and so on. So it varies. Nevertheless, though, it's still about 1/3 of what versus the total cost, because the land cost is the most significant component of cost in Silicon Valley. And if we look at two bumps that we have, we had a bump here and a correction, and another bump and a correction here, and then we obviously had another increase, but the bump actually took much longer to correct, and it's obviously that led to the financial crisis that we have all experienced in the 2008 to 2012. So, and if we look and we're trying to see where we are today, and so where we are today, we'll look at different areas. So we look at the San Francisco area as an area that has significantly, basically the prices have significantly appreciated compared to the 2008 bubble to 2012. And we are already past those limits. As you can see, if you look at it more closely, you see some correction, and those kind of correction that we see here basically did happen when back in the end of 2018, the Fed started increasing their interest rate, which resulted in the stock market, the drop of about 20%. Okay, that's the drop of the 20% here. And then with the Fed increasing, basically changing course and reducing against the interest rate, which again resulted in a rise in property values. And again, we have some correction here with the coronavirus hitting us. So this is our San Francisco area. If we're looking at Las Vegas, Las Vegas has not yet recovered from the bubble that they experienced back in the 2002 to 2007. And as you can see, a very dramatic and sharp increase, a dramatic fall here, and yet not even recovered from those peaks of the previous bubble. And if we look at another area that we're investing in is Phoenix, similar story, but a faster, better recovery, where we still have about 30% gap here versus the gap that we see here in this area. So if we look at Atlanta area, we see that actually, like Silicon Valley, has actually surpassed the highs of the 2007, and they are already above those values today. Okay, good. So if we look at the, obviously we look at the long-term view on the demand side. So obviously what we see here that anytime we see that the ownership rate, okay, this is red is the ownership rate, and ownership rate meaning people who own homes versus rent, obviously the connection is very obviously that the vacancy, which basically on a rental property, which basically goes to affordability, which we're going to touch a little bit later. So anytime more people can buy homes and own them, we see that the vacancy rate goes up, because those people who can buy, basically they're making the rental properties, and if there is not enough demand or enough growth, then basically the vacancy rate. So one of the things that we have to, when we are looking at investing, is we obviously want to make sure that we're investing in area where the affordability is not very high, because if the affordability is very high, so much less people are going to need rental property. So this is the kind of balances that we're going to be watching in the future as we are looking into our investment properties. So this is obviously what we see the dot-com crash here, where this what we see here that the ownership rate basically goes down here. Okay, we see here that once the ownership, once we see here the dot-com crash, ownership dropped dramatically. Okay, we see dramatic drop in the ownership, which obviously result again from an obvious reason that vacancy rate drops as well. So what we can see is that vacancy rate and ownership are basically tracking each other. And so the simple conclusion, as I mentioned earlier, is the more affordable it is, the less it's attractive to invest in those areas. So if we look at this kind of the relation between supply demand, and what we're looking here is that the increase in labor force. Okay, so obviously one of the big consideration for investing in real estate is always asking the question, who are the people who are going to be renting the places? What is the status of the job market, the local job market? And what we want to see in general, we want to make sure, we also want to see in general that the labor force increase, okay, is faster than the percentage of housing supply. And you always want to see a gap between labor increase and supply, okay? If it's reverse, then obviously your rental unit is going to be staying vacant. So we want to watch all the time the relationship between the labor force increase, which basically increase the population. When we look at the population growth, obviously there would not be a major population growth unless there is places for people to work. So we always want to watch that kind of ratio between job growth and supply growth. And if we look at Silicon Valley, we see that every place in Silicon Valley, from San Jose compared to San Francisco, that has a bigger gap. And obviously, one comment about this, the gap today, with the coronavirus, we know that there's a lot of people who are basically now realizing that being confounded to a house, a multi-unit with no yard and space for the children to walk around and kind of get some, release some energy. And we see a lot of influx of people from big cities, whether it's San Francisco, New York, and other, into the suburbs. But in general, what we want to see here, again, this gap between labor force increase and supply of housing. And if we look at Silicon Valley again, Redwood City, large gap, Mountain View, Palo Alto, large gap, Cupertino, and so on. And that basically touches one of the points that we're going to be talking a little bit later, and that is making the case for buying investment property in Silicon Valley, which this gap between labor force increase and supply is one factor, obviously not only factor, but one factor that is boding very well for Silicon Valley real estate investment. As we move forward, we see a very impressive chart that talks about 50 years of median price change in the United States and California. California is the bars, and the United States is the red line. And what we see that over time, we obviously had significant appreciation over year. There were some time when we see some correction in the market, and each one of those is to do something with the economy. During this time when California went through, quote unquote, the dividend of the end of the Cold War, which basically resulted in a lot of base closure and a lot of defense industry moving away and closing California's industries hub, defense industries hub, particularly in Southern California and somewhere in Northern California. The next correction what we see in this market is during this period. Obviously, this is the financial crisis where we've seen prices dropping as much as almost 40%. And as you can see, the correction was obviously painful to a lot of people, but short-lived in terms of the duration of that. And we see another correction here, but there, from their point on, we see some significant appreciation in California as well as in the United States. If you take another look at the US, for instance, you see that over a period of 51 years, there was never actually a price correction in the median price of the United States. Basically, that if you guys have watched the movie The Big Short, one of the justification for this craziness during this period was the fact that people looked at the chart and say, hey, price in the United States never correct, which obviously we know is not the case. So if we look at those 51 years of median price appreciation, we see that on average, the US has appreciated about 5.3%, and while the California appreciated about 7.27%, which is a very impressive number, particularly if you look at the built-in leverage most real estate has. So, and that's a very impressive number that we are looking at. And as I said, if you put on top of that the leverage, the kind of return that you can expect seeing are quite significant, particularly when you look at the cumulative effect of that kind of appreciation. And obviously, we always have to look at it in reference to what? So the easiest reference that many of my investors are looking at is obviously the stock market. And the one benchmark which is closely followed by a lot of industries is the S&P 500, which tracks the largest companies traded on the stock market. And if you look at their return is about 8.3%, which is higher obviously than California and the United States. But if you look at what I refer to as the average investor who invests in the stock market is probably does not uses leverage, and because of that, their kind of return that they are experiencing are different. Obviously, it has other benefits, and we don't have a scope of actually getting into those right now, but I'm sure that you will be able to find it. And if you have actually a question, I'll be more than happy to talk about those kind of advantages. Compare and contrast the two asset class, the stock market and real estate. So if obviously all that has an impact, and what we see here is that the net worth gap between renters and homeowners is significant. And this particular chart is without counting on the value of the home, okay, which even is more significant, because what it basically said that home ownership not only that has a financial return, but it has also a psychological impact on people, which make them more saver, more investor, and so on. And as we see that the gap between renters and homeowners actually grows over time, and to a very, very significant, if for people over age of 36, the gap between homeowners and non-homeowners, excluding home ownership, is significant. And if we look at another chart which was put together when we are considering actually housing as an investment vehicle, we look at the gap also between renters and homeowners, okay? And here we have about the ages of 50 to 64, where we have the home equities in red and other indirect benefit of homeownership in blue. And if we go of the age of 65 and above, then the gap is even further, and we see both increase in the home equity as well as other asset classes, while the net worth of renters are a miserable, unfortunate, less than $10,000. And I don't know exactly all those kind of circumstances where people are renters versus homeowners, but nevertheless, though, these are the facts as we can see that. So I want to also draw a distinction between a home versus a house. A home is, as you can see, is a place where you and your family live in Silicon Valley. the decision to either buy a home or a house is different, and there are things in common as well. And the decision is primarily influenced by intangible. When we talk about intangible, we talk emotional, location, school, and so on, and financial consideration, price, down payment, and so on. When we talk about a house, which is basically an investment property, obviously the consideration are different. The city is primarily influenced by tangible consideration, price, return on investment, price, down payment, and so on. But you also can tie, the fact that you buy an investment property in an area where there are good schools and is a safe environment, you typically will have a better chances of getting less maintenance issue, more retention of tenants, and so on. They're not totally disconnected, but these are the primary reason influenced an influencer for making either a decision to buy a home or a decision to buy a house. So when we are now, I want to talk about the financial benefits, the tangible benefits of home ownership. Okay, obviously, and we're going to be talking about both a home and a house. So a home, obviously, where your family lives, is in blue, and a house, which is an investment property, is in green. So as you can see, there are some things which are obviously in common for both, and which are different. OPM is obviously the other people money, which is the leverage that I mentioned before, that the overall majority of people who own real estate, whether a home or a house, are using, which is basically a mortgage, okay? And when we have the long-term as a cumulative appreciation over the year, as we discussed earlier, what we see that you have your future value of your investment is equal to the principal, the purchase price, and plus the rate of appreciation. And obviously, because it's a long-term investment, the N stands for the number of years of ownership. So as long as the rate of appreciation is positive, okay, it's greater than zero, you have appreciation, and once the rate of return is negative, it's depreciation. Depreciation in the sense that the house loses its value. And obviously, the compounding effect, which is an exponential, has a tremendous impact on building your net value. It's also a hedge against inflation, and hedge basically means it protects you against inflation. And when we have a home, we have two ways of hedges. One is that's many times most typical loan or mortgage that people are taking is as a fixed loan, either a 10-year fix or 30-year fix. And basically, we know that the long-term inflation in the United States is somewhere between 2 to 3%. So in a sense, the real money that you owe the bank every year drops between 2 to 3%. Okay, so first of all, that's one hedge. The other hedge is that we know that we've seen the median rate of appreciation in the United States, and it's about 5.3 in the US, in California about over 7%. We know that basically the homes appreciate above inflation. Okay, and typically, if you look at the Case-Shiller chart, you will see that the median US price roughly on average appreciate with inflation plus 1 point. And those particular chart that we show, that it actually shows roughly the same kind of numbers, and obviously on the average, but particular areas appreciate inflation plus 2, 3, 4, and 5 points. So that's the two ways that we have in the home ownership, versus in the housing. There are three ways, and the third one, when you have an investment property, as everyone knows, that typically a rent increases with inflation. So we have two hedges with home ownership, and we have three hedges with investment properties. Obviously, pay off principal, and it's forced saving that the owner is paying as an owner occupied. And when you are investing in real estate and you're breaking even, then obviously that is paid by the tenant. Um, Additionally, there are many government incentives, and since government and taxes is not of our expertise, we want to make sure that before you're making any real estate related decision, you're going to speak to your tax advisor to make sure that you have a full understanding of the tax implication of investing in real estate. So when we are in the home ownership, as a home versus a house, we can deduct interest rate up to $750,000. By the way, that was changed by Trump from $1 million and $1 million, another $100,000 home equity line. They dropped it to almost $350,000. And property taxes, which basically is now capped at SALT, state and local taxes, to $10,000. Again, that was the Trump tax law that was basically particularly penalizing people who live in California and New York and kind of mostly the areas where housing is relatively expensive and property taxes are much. Previously, if you you were not subject to AMT, you would be able to deduct most of those property taxes. And if we look at the median price of California, let's say roughly Silicon Valley is about $1.5 million, then you know that Prop 13 limits, and it's about 1.25. So on 1.5 million, roughly will pay something like $18,000 of property taxes alone, but the limit, the cap is on 10,000 in state and local income taxes, which means that basically many people lost a lot of their tax benefits locally. Tax-free capital gains. Obviously, what that means, if you live in an area that has a very nice appreciation, as a married couple, you can have $500,000 tax-free capital gains, which is very nice. And if you're single, you have $250,000 capital gains free taxes. There is something called the super tax saver, where if you bought a property, which we see that a lot of Silicon Valley, where people bought a property many years ago, so they have capital gains in excess of almost $1 million, $2 million. So they can basically shelter that kind of taxes by doing kind of a combination between turning their home as their primary residence to a rental property for 2 filing seasons, roughly 2 to 3 years, and then selling that and continuously doing investing and so on. And that will basically shelter your entire capital gains against taxes. That's a more complex process. Anyone who has an interest in this subject, I'll be happy to talk to you about it. Deduct all expenses and depreciate improvement and deferral taxes. Okay, so we saw that when you buy a home, you can deduct interest and property taxes. But when you are investing, you are a property owner and you own real estate as a business, and your business is rental property and rental income, you basically have no limit on the expenses. And in addition to that, you get a bonus of depreciate improvement, which basically this element is a paper loss, which doesn't cost you real money. And you can also defer all capital gains taxes. So when you sell the property, you can do an exchange basically, and the exchange allows you to defer your taxes when you exchange from one property to the other. And actually you can defer taxes to its entirety, as if you make that part of your estate, which obviously a limit of in today's to roughly about $24 million for a family that you can pass your estate to your children and so on. Monthly income for life of ownership after deducting all expenses. So we talked about our plans are to basically have passive income for retirement, because otherwise you're going to have to work for your entire life. And I know that nobody or very few want to be in that position. And if they are in that position, it's more hopefully of a choice rather than no choice. So, but that is actually was our plan since we arrived to the United States back in 1985 to develop those sort of generator of passive income for retirement. And obviously used for equity for a source for kids, college, parent support, retirement, and emergency. For instance, now my sons are reaching an age where they are getting married, and Obviously, part of our commitment to our children is trying to help them without spoiling them too much. And basically, one of the things we can do is use some of the equity that we build in our investment properties to basically help them in this endeavor of establishing a family, finding a home, and so on and so forth. So when we talked about investments, so there are different asset class, different type of properties, and so on. So what we basically, there's the commercial one, and as you can see, that basically that's sort of grayed out. And the reason it's grayed because we are directly, the urban group is not directly doing any commercial real estate. As I mentioned earlier, my son Amit Urban, who is doing more of investing in the commercial side. So if anyone has an interest, I will be more than happy to put you in touch with them. So on the commercial side, we see apartment complex and so on and so forth, retail center, storage, hotel, mixed use, mobile, and so on, residential multi-unit, land, raw land, and so on. And what we see here is that the value is basically driven directly from financial metrics. In general, commercial real estate and even all type of investing real estate, whether it's commercial or residential or even single family home up to 4, which we do, is very much driven by matrix, okay? By ratios, by cap rate, the gross rent multiplier, internal rate of return, cash flow, and so on. And there are many other parameters, but the message is very much oriented to our finances. When we buy a single family home up to 4, the decision is obviously has an element, financial element, but mostly it's intangible, as we discussed earlier, family, school, and so on and so forth, versus commercial, which is strictly and very much driven by ratios. And there are other venues to invest in commercial real estate, REITs and DST, Delaware Structured Trust, and typical ownership pools and so on. So there are different types of investment, as I indicated earlier. These are the type that we do not directly involve in, with the exception of the hotel that we participate in Portland, which was our first commercial investment. But in general, these are outside of our expertise, and we obviously can refer you to people who have expertise in these asset types. The asset that we are involved in is mostly single-family residence, single-family, detached, attached, okay, and condominium and townhomes, and multifamily up to 4 units. This is our forte. This is what we understand. This is what we are comfortable. This is what we are good at. So this is our presentation is geared toward that asset types within this asset class, which is called real estate. So obviously, this is a quick chart, and I'm not asking anyone to basically, and we would not go over all the details of that, but there is many factors that when we compare residential to commercial, there are many differences. And I just listed some of them. As I mentioned earlier, anyone who will send us in the private message or email their name and email address, will be happy to share the link to this presentation.